What's going on? Welcome back. Ryan here. In this video, we are talking about market internal indicators. Now, I have Thinkorswim loaded up, except this time I've loaded the real money account, right? It's connected, it's real-time data, and I'm on the charts tab. And over here, there's a little box here where you can create grids, you can create custom grids. And one of the custom grids that I have is the internals grid that I've created that has all of the important market indicators that I use to look at the strength and the power and the trend that the overall market indexes are making, right? So when I get up in the morning, when I look at the market opening, a lot of the time I'm looking at the volume of the overall market. I'm looking at things like the tick, the TRIN, the VIX, right? The put call ratio. And I'm just seeing what the overall market is looking like is going to happen, right? So the first thing I want to talk about is the tick, right? The NYSE tick is basically showing you how many stocks are ticking up versus how many are ticking down. And this is super important because based on this tick, we can identify areas of support and resistance as well as areas of reversals and different areas that we as traders and option traders can use to our advantage to make profitable trades, right? So if we look, for instance, down here, I'm looking at the Qs, right? The NASDAQ, here's the spider, right? We can see that today, towards the end of the day, around 11 o'clock, which is when the Fed meeting was, that this market started to rally. And we could see that at one point, the market was like selling off, right? We have a negative tick reading of, what is that? That's like negative 977, right? So there were 977 stocks that were declining. Like the overall ratio of positive to negative was actually negative. But based on that catalyst of the Fed meeting, we could see that when the market was starting to sell off here and then it said, no, this is positive, we're going to rally, we could see that this low tick reading was actually a buy signal, right? And then the market rallied, the tick went up above, zero, and then eventually it made a high of 1331, which we could see that once it made that high, right? Once it made that high right around here in this area, that then the market then sold off a little bit, but then, continued to rise, which is, showing that the overall advancing ticks of up stocks versus down stocks was positive, right? So the tick, I love it. It's super important. If you haven't used it, please go, look up more about it. Start looking at it. Put it into your morning routine of when you start to look at the markets and you're starting to look at price action. I highly suggest looking at the tick, okay? I also suggest looking at the volatility, right? Volatility impacts, option price, right? So if we look at, this volatility here, volatility usually spikes and then it settles back down and then it spikes again. And there's a lot of different trading strategies that we can use purely based on the VIX. So another really important one is volatility, right? Another one is the New York Stock Exchange advancing issues, declining issues difference, right? So again, a lot of these market internal indicators have to do with like volume of positive versus volume of negative, and we're looking at the difference of these ratios to look for opportunities when with our entries, with our exits, and also when the market is going to change direction. Okay. This one down here is the put call ratio for all OCC options. Now, on Thinkorswim specifically, there's different put call ratios, right? There's one for the S&P 500, there's one for the NASDAQ, there's one for the Russell. They each have their own little ticker value, and you can look at the different put call ratios, right? We haven't got into these options yet, but just know the puts and calls are options, and it's quite common to look at the ratio between how many puts are being bought versus how many calls are being bought, which can give us some insight into the sentiment behind the overall market move. Okay, and another one here is the S&P 500 up volume, down volume difference. Again, this is another internal indicator that, you know, you have zero and you have positive and negative, and we're looking at the volume, the positive volume versus the negative volume and how that affects the market. Now, I know that I'm quickly going over these. I know that I'm not digging too deep into them. And the reason why this is because each of these indicators has a history, has a creator, has math behind it. And I think it's important that as a teacher, as a coach, that I not only instill the ideas of these things for you to look at, but that I encourage you to constantly be teaching yourself and learning as much as you can, right? Super important to realize that in the world of coaching and the world of business and stocks and investing, there are no guarantees. And one of the reasons that there are no guarantees is because, even Tony Robbins in his course, some people buy Tony Robbins' course and they don't even do it, right? Some people might buy this course and they might not even go through it, right? So I can't make you do the work. I can't make you educate yourself. I can't make you do the work necessary, right, to study for the Series 3, to take that test. Nobody can do that except for you. I can sit here and I can encourage you. I can, speak faith into you. I can believe in you. I can show you the insights and the places that I've failed and the places I've succeeded, right? And I can try to help you as much as I can. But at the end of the day, it's ultimately up to you, right? Your destiny is in your hands, okay? And my job is to inspire you and to tell you to never give up and to give you all of the tools necessary so that you can be successful to whatever degree that you want, right? So again, I'm not going to dig too deep into these because I want to encourage you to go start, researching more, looking more, always be open to learning and trying to solve problems on your own by scouring the internet for resources, scouring the internet for ideas and opinions, and then being able to decipher what's going to work for you and what's not. And of course, I'm always available for you to reach out and ask me questions directly, right? So another really important one is the TRIN, right? The TRIN is the ARMS index. And the trend is really interesting, right? Because again, the barometer for the TRIN is 1, and the overall sentiment of the market long term is usually positive, right? So when we look at this on the day, we can see that most of the time this is going to hover around 1, and it's also going to go above 1. It's going to go below 1. And it's when the market gets too out of balance, right? When it's too much above 1, this trend can give you a buy signal, right? Because it's basically saying the market is oversold. This bearish sentiment is probably not going to continue. And this trend can help you see that, where these high probability scenarios of reversal happens, and we just want to be aware of, again, these market internal indicators and the overall way the market is moving and the strength that it's going to do so, right? So thinking back to the TRIN, if we look at the TRIN and one day that the TRIN is really in like a narrow range, right? Maybe it's not going above 200 on the positive and it's not going below 200 on the negative. We can see that the overall strength of the market is just, wouldn't be very much, right? There's not that much volume or volatility, and it's just kind of more passive, as opposed to days where it's very volatile. The markets are making huge swings and there's huge buying and selling pressure. And that will be obvious when we look at these ticks, and then we can start to see where you have tick readings above 1,000, right? When tick readings start to go above 1,000 or even above 1,500, we know that the market is capable of making, some serious moves, and that's something that we should be aware of. And then down here, right, I just have the spider and the Q because I want to see the way these indexes are moving in relation to my market internal indicators. Okay, so again, these market internal indicators are important. A lot of people overlook these, and until you get a little bit more experience or until you have somebody tell you about these, some people, they might not even know that they exist. So again, I hope that you look each one of these up, look at the history of kind of how it was creative and get like a little bit more insight into each of them by going and really looking up in detail exactly, what they are, how to use them, how to look at them. And again, I'm excited. I'm happy that you're here investing in yourself. All of these things are going to play a role in your success because as you look back, as you get better, some of my methodologies and the things I'm teaching you, they're going to make more sense as you become more comfortable, as you become more confident, and as you start to use some of these tools more. So again, super excited, and I look forward to seeing you in the next video.